All right, today we are going to start chapter 1, which is basically just the introduction chapter. So we're going to walk through a few of the things. The first thing that we want to talk about is what is auditing. Auditing is different than most of the courses you've had to this point in accounting. In other words, we're not learning specific rules, we're not learning GAAP. Instead, we're learning how to gather evidence and evaluate evidence to determine whether someone is choosing to follow GAAP. Are they using the rules correctly? We're not learning additional rules. We're learning if they're using the rules correctly. So we have to be much more analytical whenever we look at these things. There's not necessarily a cut and dry. We have to use a lot of judgment. So why do we have this demand for audit? Well, when we developed corporations and we had a separation between the people that owned the company and the people that were running the company on a daily basis, that gave rise and the need for audit. You can see that when we talk about principals and agents. So when you think of public companies sell stock to the public. So public companies can have lots and lots and lots of stockholders. However, those stockholders are not there running that business on the day-to-day basis. The stockholders are what we call the principals. So there's a theory called principal agent theory. And basically the stockholders are the principals. They are the owners. They have the rights to the company. But the people running it are the managers. Those are your CEOs, your CFOs, your COOs, all those nice C words. Those are your agents. They're doing the business of the principals. Okay? Now, what's the problem with that? Well, when we look at this figure, what you see here in the middle, right here, we have this thing called information asymmetry. What that means is the agent or the manager running the day-to-day business of the company can hide information from the principal, the stockholder, the owners of the company, because they're not there on a daily basis. So because those stockholders don't know what's going on a daily basis, the managers can hide information from them. Okay, and this leads to what we call right here information risk. Okay, now this is where the auditors come into play. So, since the stockholders cannot necessarily trust the information that's been given to them by the managers, auditors are there to look at this information, to gather evidence about this information, and to examine the accuracy and the fairness of the information provided by the manager. So that's what auditors do. They provide essentially accountability. They provide accountability that the manager is providing accurate and fair information. So in essence, they reduce the information risk, which is the risk that that information is incorrect and can lead to wrong decisions. So specifically, what assertions are management making? Because when we talk about auditing, we're talking about looking at assertions and evaluating those assertions. Assertions are just kind of like facts. So what assumptions are we making? What are we saying about the audit or about the information that we're presenting? Well, we can break this down into two categories, and I'm going to go ahead. This is a summary. I've also provided you a summary of this information on D2L that I've kind of put in my own words. So it's hopefully gives you a little bit different perspective. But let's break these down into the two categories. One category, these at the top, deal with transactions and events. These here at the bottom deal with account balances. All right, so let's take a look at these. All right, the first one that we're looking at is occurrence. And when we talk about occurrence, we're saying if a transaction was recorded, did it actually occur? Okay, so everything that's in those financial statements actually occurred. We didn't record anything that did not occur. We didn't make things up. Okay, the second is completeness. This means if a transaction occurred, it was recorded. It was complete. Our financial records are complete. Everything that should be in there is in there. Every transaction that should be in those financial statements shows up in those financial statements. The next assertion is authorization. Authorization means that every transaction or event that is in the financial statements had appropriate authorization. In other words, we didn't have things that were not allowed occurring in the financial statements. The next is accuracy. Are the amounts accurate? Are they appropriate? Did we record things at the right amount? The next assertion is cutoff. Cutoff refers to accounting periods. Remember, with financial statements, we draw arbitrary beginning points and end points. Typically with financial statements, we're talking about quarterly reports and we're talking about annual reports. But the business doesn't stop at the end of the year. It keeps going. So this cutoff assertion means, did we record things in the right accounting period? Did they get recorded in the period they were supposed to be recorded in? Next is classification. Did we classify these transactions in the right accounts? And the last is presentation. Did we present them appropriately? If we should have aggregated, did we aggregate? If we should have separated this information out, did we separate the information out? So these are all assertions that we're making about transactions and events that occur. Now, management also makes assertions about the ending account balances. The first is existence. Did these accounts truly exist? In other words, we didn't make them up. Okay? Rights and obligations. So this deals with our assets and our liabilities. Remember, assets are things that we own. So, did we actually have rights to all of our assets? Same thing with liabilities. Remember, liabilities are things that we owe. So, did we actually owe these obligations, the ones that are recorded as liabilities on our financial statements? Next is completeness. It's very similar to completeness. Matter of fact, the next four, completeness, accuracy, classification, and presentation, are all very similar to what we've already seen in terms of the transactions and events. So completeness is, are those account balances complete? Do they contain everything that they should contain? Next is accuracy and valuation. Are they recorded at the appropriate amounts? Did we value them correctly? Think about things like lower of cost or market. If we have inventory, is it valued at the correct amount, or is the market value actually lower and we should have reflected that in our financial statements? That's an assertion. For classification and presentation, they're very similar to transactions and events assertions. These are, did we classify everything correctly in terms of assets, liabilities, and equity? And did we present them how they were supposed to be presented? So next, we're going to look at a knowledge assessment. Okay? So what I want you to think about, we're going to read this, and then we're going to talk about why the correct answer is the correct answer. All right, so it says, an auditor performs a vouching test on accounts receivable by looking through the general ledger, identifying sample accounts, and finding original supporting documentation for those balances. This test deals with which of the following management assertions? All right, so let's think about what we did here. The auditor is vouching, okay? They're vouching accounts receivable by looking through the ledger. So they're looking through the ledger. These are the books, right? They're looking through the books. They're finding some accounts receivable accounts, and they're tracing the information for those sample accounts receivable accounts back to the supporting documentation. Okay, so let's think about what we're doing here. We have existence. Remember, existence says, did everything recorded in the financial statement actually occur? Okay. Does it actually exist? All right. We have occurrence. Okay. If we look back, occurrence deals with transactions, specific transactions. It doesn't deal with accounts. So existence and occurrence are very similar in what they mean, but existence deals with an account balance. Occurrence deals with a specific transaction or event. Okay? Next, we have completeness. Now, completeness can be for either one. And we're saying, is that information complete? Did everything get there? Last but not least, we're looking at accuracy, valuation, and allocation. Okay? All right. So we have to think about what this means. Okay? What are we worried about? Well, we're performing a vouching test on accounts receivable. All right? So we are looking at a specific account balance. So since we are looking at an account balance, we can automatically rule out B, because B only dealt with transactions. Okay? Now, what we want to do is think about what we were doing. We're vouching. We're starting at the books, the ledger, finding sample accounts, and then looking for that supporting documentation to prove those balances exist. Okay? So the correct answer here is existence. We are taking information and we're proving that the account balances do exist by starting at the books and going back to the documents. Whoa, that didn't work out so good. To support the existence of those accounts. Now, this is not completeness. To test for completeness, if we're worried about our books being complete, we don't start looking in the books. Because if it's already in the books, we're only worried about, does it actually exist? To test completeness, what we would do is we would start with the documents and make sure that for all the documents we had, we found that information in the books. Okay? So that tests for completeness. Think about cars on a car lot. Okay? If we were testing for existence, we would make sure that if a car showed up in our inventory, that we could find it on the car lot. It was in our books, we made sure it existed. Completeness is the opposite. We want to make sure that everything on the car lot is in the books. So with completeness, we would start at the car on the car lot. In essence, those are our documents when we're talking about accounts receivable. And we would trace that back to make sure that we could find that car in our books to make sure that our books were complete. Okay? So that is why this is not completeness. It is existence. We're trying to determine if these accounts receivables do exist. Now, why is this not accuracy or valuation? We're not worried about, are they valuing this account at the proper amount? That would deal with like aging and collection of accounts receivable and things like that to determine if we had valued the accounts receivable at the right amount. In this case, we're just trying to determine, do these receivables exist? And companies may try to hide that because accounts receivable is an asset. We like assets, so the more we have, the better we look. So we want to make sure that these things, in fact, do exist, and we can do that by what is called vouching. Okay, so the correct answer was A, existence.